Today I'm talking to a crypto protocol, a DeFi protocol that facilitates billions of dollars of trading, and they are launching and implementing a variety of new trading strategies using AI, which I think are very, very exciting to retail customers. Can you tell me a little bit more about who you are, what you do, and how AI fits in?
Yep. My name is Brennan Pete. I've been in the space for a while, founded a trading firm, a prop firm, research firm, and one of the fastest growing DeFi applications in the industry. Previously, currently the founder of Project Zero. And what Project Zero does is it integrates the most widely used DeFi protocols across the industry. So currently we have multiple markets across Camino, multiple markets across Jupiter. We had and will have, once Drift comes back online, actually multiple markets across Drift. We have P0 native markets. We're looking cross-chain. We're interested in, Morpho markets, Aave markets. We're interested in hyperliquid perps. We can kind of cross-margin a variety of DeFi programs that people use the most for, whatever reasons they're currently using. But what we do is we give you a unified margin portfolio over that. So what that means is you can access all these different protocols with unified margin, credit, risk, rates, and UX. Meaning simply, if you have $100 in Jupiter and $100 in Camino, you could borrow against a $200 portfolio through P0 and you'd get a single rate, a single account health. You get credit adjusted to your positions, perhaps you have offsetting positions on two different venues. And this is essentially facilitating the role of what a prime broker kind of facilitates in traditional markets that is largely lacked in DeFi markets. Right now, everyone uses multiple DeFi applications, but the capital is immediately fragmented. So that's what we do in a nutshell.
Okay, so if I understand correctly, basically, if I notice that there is a crypto ticker trading at one price on one exchange on futures and trading on another price at another exchange on futures, I can go long on one side, short on the other, and effectively I can lock in this price differential in a way where it effectively becomes very, very hard to liquidate me because I have both positions serving as collateral in the same place. Is that how it works?
That's how it works. Yes, we're very focused on the yield component of that. So a great example of what you just described is perhaps you're long Bitcoin spot on Camino Lend and you're earning the interest. And then, we're looking at integrating a perps venue next. We have a lot of credit venues integrated right now, but perhaps we integrate a perp venue and you're short the Bitcoin perp on that perp venue. You then be running a cash and carry trade. Your delta would be minimized. You'd be able to borrow against this combined position and you'd be able to capture, the funding on the perp side in up markets and the yield on the spot side in basically all markets and then lever up that basis. So yeah, exactly.
So obviously this introduces a lot of different moving parts, right? Because every single exchange, every single venue that you operate on then becomes another potential source of friction or source of potential security risks or whatever. I'm curious how you guys navigate it, particularly with the recent incident that happened on Drift. What happened there?
Yeah. So this is a very, very hard problem. And I think that's probably why we're sort of the first, actually making this work. This has been tried briefly before, but it hasn't worked. We're now, 7-8 months old. We've grown to over 100 million in TVL, and it is working. And it is even working when we have integrated venues like you've mentioned that have the worst happen to them. Like Drift, for example, recently got exploited for $250 million. They were one of our integrations. And so as with any traditional market prime broker, we isolated risk, we contained risk in that event to Drift specific lenders. So that means if you were using the Drift program through P0, you received the blunt of that socialization markdown, essentially. And currently we have Drift assets marked at zero. Drift actually isn't really marked at zero. It's marked at about 50 cents if you look at their programs reserved, but we just proactively mark them at zero and we'll pass on as these assets unlock these assets back to lenders, but we isolated risk and contained risk primarily to Drift lenders during this incident. So if you had a deposit in a Camino market during this entire ordeal, you have 100% of your collateral. in P0 right now. And that's not easy. That's very hard to do. And that's like an extreme like risk management exercise, but that's kind of what it takes to build out something like this. So in many ways, now as people are looking at their exposure and wondering, you know, okay, what happens if, you know, a drift event repeats, you can actually diversify your risk as well through P0. You can have collateral across multiple venues. And then when you do need a unified borrow against your entire portfolio, you can still get that through P0.
Okay, so,
Yeah.
so help me understand. Let's say I have $10,000, of which $1,000 are with drift.
Yeah.
Does that then mean that I, as a user, basically am exposed only to the extent that I have assets on drift, or does it mean that you know, my whole entire account, because I'm a drift user, is potentially exposed to socialization, or how does it work?
Yeah. So it's very like there's not a one size fits all answer to this because we have so many markets integrated, because all assets have different risk profiles. Like risk is never uniform across assets. But like the best way to answer that, I think, is if you have, I think it was a $10,000 portfolio and $1,000 is in drift. In like the event that just happened, your $1,000 in drift would be immediately marked at zero. So you would no longer be able to borrow against that $1,000 in drift. And for all intents and purposes, that $1,000 you had in drift specifically, you know, given drift doesn't do anything with the remaining funds, which is doesn't seem to be the case, but if they weren't going to do anything with the remaining funds, that would stay at zero. So you're down $1,000, like as a user. However, if you've had that collateral on Camino or the remaining collateral on Camino or Jupiter Lend, that's isolated, and that was isolated during this incident. The only other risk you pose is if you also have collateral in the P0 main markets. This is where we extend credit against all third-party positions. So if you have collateral in the P0 main market, this could receive a markdown. It won't be anywhere near what you received in drift. Like during the drift incident, for example, some people in the P0 market in particular also received a markdown. So these markdowns ranged from like 1%. They were at 1% and 1.5% for like our most liquid stable coins. There was a few portfolios which had like very risky assets that moved like 5% a day. They took about a 6% markdown. That was the maximum. But most of the risk is contained to like the venue of choice. And actually, as we grow, this becomes easier and easier. So we did this with, in my opinion, like a smaller capital base. So this actually like increased the respective percentages that people outside of drift could have been impacted. If we're 7 months old, we're at 100 mil now. If we get to $1 billion, that exposure like goes down by 10x essentially. So one of the safety mechanisms we have is essentially grow our assets, grow our TVL, and that puts us in a better position to further insulate risk if an event like this happens in the future. Like one final thing I'll say is we go through a very rigorous exercise of every single venue we integrate, and that includes smart contract risk, that includes OPSEC risk. Clearly, we miscalculated OPSEC risk with this drift incident. It seemed sophisticated. It involved like North Koreans, like tricking people who had access to keys. That's really hard to build into your risk model, essentially. But every new asset we integrate into P0, we go market by market, asset by asset, venue by venue. So if it doesn't meet our risk profile, we won't integrate it in the first place. So it's also, when people come to P0 and they see the markets that we're offering, these have gone through our internal risk assessment. So it's by default a better place to park your capital than if you were coming to DeFi and had no idea, you know, what was risky and what wasn't, essentially.
Yeah. I mean, if you think about it, my initial intuition without knowing a lot about it is actually if the worst exposure for people in the common pool on stablecoins is about a 1% write-off for a major protocol in the space being effectively hit, then
top 10 largest hacks in DeFi history. Yeah,
exactly. Then it doesn't, by the sound of it, doesn't sound like you guys were hit very hard. Like obviously your users who had significant drift exposure would probably, you know, there's probably some people who were in particular hit very hard, but these are all people who chose to use
Correct.
that venue, right? So they're not necessarily people who chose to use you as a protocol to offer credit, etc. These are people who chose to use Drift as a venue in particular.
Yep.
So they
Exactly.
willingly assume that risk. Cool, got it. And it's super cool because since last time we spoke, I think this hadn't happened.
Yes.
And we got to see how the risk model worked in practice. And I think, I mean, again, without knowing a lot of details, by the sounds of it, it sounds like you performed relatively well. Cool. Let's move on to the more exciting part. Not that risk isn't exciting, but maybe people don't necessarily wake up thinking about it to that extent, which is the whole AI part of things, right? Because I think one of the things that AI is going to unlock is the ability for relatively sophisticated but technically less sophisticated individuals to be able to trade in a far more sophisticated way. This is the rise of vibe trading, the ability to be on multiple venues with best execution, with arbitrages up until then were not necessarily possible. Tell me a little bit about what you guys are doing in the AI space.
Yeah. So when I think about trading, I think primarily about trading yield, not trading prices. So
Of course.
not necessarily taking directional exposure on something going 10x, but seeing a difference in spreads across market and taking advantage of that, often from like a delta neutral posture. And that's what P0 is also extremely focused on. It's actually very less focused on right now, enabling you to go, like 10x levered long on any particular asset. It's very, very good and actually uniquely provides the ability to arbitrage spreads across different venues with a unified margin account instead of having this fragmented, multiple fragmented accounts that also have no idea of your risk exposure across different venues, which might improve your holistic position, but without combining risk, you actually are worse off. So one of the initial products we've launched in this direction is P0 Strategies. And what P0 Strategies does is it surfaces these spreads that we can uniquely provide across all of our integrated venues, given the fact that we've built out this prime margining engine that can also extend credit against third-party venues permissionlessly and adjust risk permissionlessly. So what that does is, like a good example is perhaps you want Bitcoin exposure. You've chosen that you want to be long Bitcoin. And now that you have the Bitcoin asset, you want to maximize your yield on it. Now, perhaps there's a really high lend rate on Jupiter Lend and a really low borrow rate on P0. Historically, you haven't been able to do anything with this because if you go and lend on Jupiter Lend historically, you'd also have to borrow from Jupiter Lend because you have to be over collateralized. Our program changes that. You can actually lend on Jupiter Lend and then borrow against that position natively on P0 on a separate venue. So for the first time, you're actually able to capture that high lend rate on Jupiter Lend, that low borrow rate on P0, and then lever that up and then redeposit into Jupiter Lend, borrow against it, redeposit into Jupiter Lend, borrow against it. And you can do that in Bitcoin products. So this is what's called a carry trade, essentially. So we have this. Yeah, go ahead.
Hang on, let me see if I understand the trend properly. So basically, I'm borrowing at a cost that is lower than the cost to lend. And I'm effectively basically building up a highly, is it fair to call it a high levered Bitcoin long? It's not really a high levered Bitcoin long, or is it a levered Bitcoin
It's essentially, it's maximizing the exposure you already have. So like, let's say, you have $100 portfolio and $50 of it is in Bitcoin. You can take your $50 and just do that with this. So, and also there's usually a lot of pricing protection here. So the only risk you're not worried about liquidation, because both assets move in parallel in terms of like how we price it. The only thing you're worried about is if your borrow rate exceeds your lend rate for so long that your account health like goes down to zero essentially,
Of course.
which actually like that usually wouldn't happen. Usually what would happen is if this ARB compresses, you just go to net zero and then you just have the same exposure. But yes, so if you have like different assets, if you have Bitcoin or Sol or just stable coins, a lot of people do this mostly with stable coins actually. We give you one-click exposure to capture these cross-venue spreads that have previously been completely unavailable to you. And also just like, even if you were trying to stitch it together with like multiple accounts and you still didn't have like a unified prime engine underneath that adjusted your borrowing power, it's still like you could do a little bit here and there, but it was still like super managing a ton of accounts is just a massive headache. So this makes it like one click. You have like one account health, you know, just exactly how you could be liquidated, like what could go wrong. And a lot of people are doing this right now. So we have like tens of millions of dollars doing this every day, rebalancing into different strategies. Our three most popular strategies right now: stablecoins, number one. So just delta neutral posture. Two, a lot of people are very bullish on Solana, and we're built on Solana. And so a lot of people are doing this with Sol and Sol LST spreads across multiple venues. They're doing it in one click. And three is likely Bitcoin. It was Bitcoin for the most part. There was a time where like Ethereum was kind of interest. There's been other things of like interest, but it's usually consistently Bitcoin in the third spot. And right now, this is a new product. It's called P0 Strategies, and this is available to people in one click, and it's working very well. But I still think it's like too manual, because you still need to press the button, and then if your yield gets to the point where there's a better opportunity, you have to press the button to rebalance. You know, like one of the things that constantly will happen is people will be doing this with Sol, for example, and then a new LST will come on P0 and it'll be like slightly higher yielding on the lens side, and then they want to rebalance into this. And we've made tools to do that. We've made collateral and debt swaps, so you don't have to unwind your position. You can just rebalance. But
you still need to do it.
You still need to do it. So this is where we're starting to look at ML, AI, and just a smarter, optimized portfolio. Because in my view, what a person wants to do with AI is they're opinionated about the exposure they want. They're going to go to AI and say, hey, I still want to be in Bitcoin or Sol or just stable coins right now, but I want you to find the best yielding opportunities for me given this. And I want you to maximize my existing holdings. And this is essentially what Strategies is set up to do on the perspective of yield.
Okay. And all right, so I really want to dig into the technical mechanism of how this AI integration would work. But before we dive deep into that, let me see if I understand the trade correctly. So if I'm looking at the stablecoin arbitrage trade, I'm on your website. There's a ton of strategies with a range of APYs and spreads. And I think the number two strategy pays me total APY of 42%. I can use a max leverage of 4.4%, 4.4x. And basically what I do is I supply USD1 and I borrow USDT, right? So if I understand correctly, let's say I deposit $1,000 worth of USDC into this. What would happen is I would swap these $1,000 in USDC for USD1, lend them out, and use the money or use that as a collateral to borrow USDT, and
then you'd swap that USDT back to USD.
And then lend it out again. Okay. And then in terms of risk, my exposure is potentially if either USD1 or USDT get, price impaired, then potentially I would have some sort of risk problem. And if the spread between the two lending rates compress, then also. Is that correct?
The two main risks, yeah. So for a lot of these pairs, we have pricing protection. So like Sol LST pairs and also some stablecoin pairs, by the way, like we have it pegged at 1. So if for some reason some market event happens and USD1 temporarily spikes up to $1.05, you'd be fine. So we have that like per pair. And then the other thing, like you've mentioned, is usually the main risk you need to worry about on the rate side is that the ARB compresses to 0. And so if it's at 0, you're not making or losing money, but it's something you got to monitor essentially.
Okay, got it. Just as someone who was around for the whole Terra Luna thing, one of the big risks that I always think of in terms of stablecoins is a big stablecoin, a big and not temporary, but rather permanent stablecoin depeg.
Yeah.
What happens then? What happens if USD1, for whatever reason, starts trading at 75 cents on the dollar or 50 cents on the dollar? In that case, I would have lent out a bunch of USD1 and then the position would be unwound, or how would you guys deal with that?
Yep, it goes per stablecoin. So USDC and USDT, for example, we use reserved back price. So as long as there's reserves backing USDC and USDT, any immediate temporary fleeting market movement won't adjust the dollar peg that we have. On USD1, for example, that's a newer stablecoin. So we use market pricing for that. And we use the way we price USD, as your example, is we use multiple price sources across a variety of venues. So we'll use Oracle providers like Switchboard and Pith and Chainlink, and even some of our own like built-in pricing providers. We'll look across multiple exchanges and see where there's the most liquidity. Maybe there's a lot on Binance, on Coinbase, on a prop AMM on Solana, on an AMM on Solana, and we'll essentially assign weightings to the uptime reliability of like the price feed as well as the liquidity depth of the price source, and take a average of all these things based on the weightings, and that will output the price of USD1. So USD1, for example, has just stayed at $1 because even if, let's say, one of our like 5 price feeds is on Solana and that spikes up 50%, that would actually trigger a confidence fail on that feed, and we actually wouldn't even use that feed in the calculation, given that all the other 4 are hovering around the same price. So we have like multiple layers of redundancy here to smooth out a correct market price for all of our assets. Certain assets have different nuances, like the ones I mentioned, USDC, USDT, some LSTs, SOL. But for USD1, yeah, it uses market price. So if it goes to 75 cents, you would probably get liquidated in that. If you have a bunch of borrows against a stable coin that immediately drops in value, your account would be put up for liquidation. And then a network of third-party permissionless liquidators would come in and repay your debt and buy your collateral, essentially. Sell it on the market.
Cool. Understood. And okay, so now that I understand the trade a little bit better, the AI component would come in terms of the ability to rebalance these positions, right?
Yep.
Because like, let's say I deposit 10,000 USDC into a strategy, like fundamentally what I care about is what yield I'm getting. So like it might be the case that the USD strategy at some point is the margin compresses significantly, so I stop caring about that as much. I'd rather rebalance towards something else. Like right now I need to do that like personally, but you could imagine a world where there is an AI agent that runs somewhere in the cloud that has the ability to sign transactions on my behalf, but only certain types of transactions. And this AI agent basically monitors the strategies and eventually executes in my behalf. Is that roughly how you guys had it in mind?
Exactly. And to further on that point, there's already teams that are doing this on P0. Like one of the cool things about P0 is that we're open source code, so anyone could come in and build stuff like that on top of us. And there are teams doing exactly that, where you come in and the main things you specify are what exposure you want. So again, like people want to be long SOL, or they just want to be in stable coins, or they want to have some Bitcoin. And then also another preference, larger thing you can tune is your risk appetite. Like, are there certain assets that you don't want to touch? Are there certain assets that, you want to stay in? Those are the 2 levers that essentially teams are already doing. And we're also like working to enable with better protocol level tooling at P0.
Cool. Understood. And what sort of exciting ways of doing this have you seen? Like you mentioned there's a few teams that are working on this. Like what have they released so far that you've seen that is exciting? Is it basically just the construction that I mentioned earlier in terms of a bot that signs on your behalf? Do you like delegate your entire private key to it? Is it just a permissionless thing that can call a certain function? Like how has it been set up so far?
Yeah. The examples that I've seen and the examples that we're working off of as we try to get better tooling for these AI agents like built into the P0 protocol is a program built on Solana that essentially has levers over those 2 knobs, over what exposure do you want and what risk appetite do you have. And then you can just fund that program. And so it's still like a self-custodial program. You can withdraw at any time, and everything's kind of transparent. And then you can track that program and see exactly what your funds are doing. So one of the cool things about AI, I think right now, is that they're still not great at, if you gave like $100 to an AI and you just said like, do stock picking and make sure my portfolio, 5X's every 2 years.
Yeah.
AI is going to be pretty subpar at that. It's going to be that's not where we're at right now. However, if you give an AI agent $100 and you say, hey, this is the exposure I want, I already have, just find the best risk adjusted yields for it. AI is actually pretty good at that. And it can just look all day. Like the normal person can't just look at a screen all day and constantly rebalance into, they got a job,
Yeah,
they
of
got
course.
their life to live. But an AI agent can. And it can just constantly be looking for the best spread, the highest lend rate, the lowest borrow rate, the cost of essentially the opportunity, the cost of capital. And it really is good at maximizing that. And also, one thing that also happens with yield markets is that they're very responsive to inflows and outflows because there's an interest rate curve. So as you move along that interest rate curve, the rates change. And so these calculations are very easy for an AI agent to do. Like if I deposit $10 million into this specific market, how am I going to impact the lend rate on that market? It's not as easy for the normal person to do. Like they got to look up the interest rate kinks and like understand the slope and the level of capacity and liquidity in the market. And so this is something that like AI is already kind of like ready for, and we're seeing real world examples of it already. We released like P0 skills around this. Again, we're looking to like build order limits into the program so an AI can like set up more granularly where it wants to enter and exit trades. And then, yeah, we're seeing teams on top do exactly this. There's teams live in production with like $10 million of TVL doing exactly what you're describing. Yeah.
Okay, so this is pretty cool. You guys release these skills as well. So in theory, I can set up a wallet, give my Cloud Code instance access to it, and incorporate the skills and say, hey, just get me the best yield that I can on these $10,000, and it would just go ahead and do it and run in the cloud and basically rebalance whenever I want it, whenever it finds a good opportunity to.
And it would give you the final like actual useful helpful thing as well of being able to then use that on-chain balance to pay for things IRL. Like the final one of the other things we built into this into our skills is our P0 Pay product, which essentially just all it does is it connects to your existing card or your existing bank account so that when you want to go buy a coffee now and you have money in P0 that's earning interest continuously, you can take a borrow against that exposure and send it right to the account that you want to pay IRL with. So you don't lose your exposure, you don't sell, you don't do any, there's no trade-offs essentially. And then you can also like finally use your crypto balance productively to, pay your rent or like buy a coffee. So we kind of went above and beyond on the skills side to try and make it maximally useful to both agents and humans orchestrating the agents.
Does this work with strategies as well? Like, could I deposit in theory $10,000 at this 40% APY strategy and then borrow against the strategy itself?
You could borrow against your existing account equity. So whatever free equity you have in your account that's not negated by your outstanding liabilities, you can borrow against. Yeah. And you can hook it up to P0 Pay via skills or UI.
So wait, hang on a sec. Does that mean if I deposit K at this, let's say the USDS USDT strategy, right? It yields me 40% APY. So if the yield doesn't compress, then by the end of the year, I'll have like whatever, like $14,000-ish. Then does that mean I can also immediately after depositing borrow up to, I don't know, like close to, I don't know, like few $1,000s against the strategy position, even though it's already levered up at 4.4x?
Yeah, in that instance, that would be unlikely because you'd probably be near maxed out on your account based on what you're describing.
Of course.
You're describing like maxing out the leverage. The borrows, anything, you'd be able to borrow against any free equity, essentially. So if you take, what's left over.
With the headline APY figures in those strategies are basically assuming I max out the exposure on the leverage, basically.
On the money you put into that specific strategy.
Got it. Okay, cool. Where do you see this moving forward, right? You guys already released the strategy. There's already teams building on top of this. Where do you think this is heading? Like what's next in this world?
Yeah, so we have a few, like, I guess, unique insights that are driving this product at B0. And I can say that because like we're the only ones, this is the only product that exists that does this cross-margin functionality permissionlessly in crypto anywhere, not just on Solana. And insight number one is that most DeFi users, every DeFi user, in fact, that I know uses two or more venues. I don't know a single user that just uses a single venue and calls it a day. Like everyone breaks up their capital, uses it across, and also different venues do different things. So you can't like do everything with one venue. So that's insight number one. That wasn't true in TradFi. In TradFi, like you could just open a Robinhood account and you're good. Like you don't need so because of that, you need a prime broker. And then insight number two is that different venues have different risk adjusted yields. So like earning 5% on Hyperliquid is not the same as earning 5% on Aave. There's different risk adjustments you need to make. And so when you enable cross margin between these different venues, you enable these long-term yield trades, spreads that you can trade, where like even if there's a compression on the rate itself, the risk adjustment is different, which wasn't the same initially, because like initially you had to be over collateralized on a single venue. You know, as the rates compressed, like risk compressed as well, and the risk adjusted rate compressed as well, and that was it. There wasn't any like underlying alpha really to continue to trade on. What that means is a lot of these strategies you see on P0, if they involve different venues, they can be open for like months. And I know this because I'm in them and I've been in them for like some months. So given those two things, our focus is on expanding access to venues that people use, because all these venues have unique products, unique rates, and unique risk adjustments. As long as they fit like our risk profile, like we're not just going to go and integrate a brand new venue that isn't audited. So that's number one. And then number two is we want to be like maximally. We do want to be like maximally useful to the two different archetypes that are coming into the space. Like archetype number one, just being retail traders. Like I'm actually very unfocused on institutions. I think if we just cater to institutions DeFi, like we should just give up. Like I think the cool thing that DeFi enables is retail. So retail, and then the agents that are being orchestrated by retail. And so, like we said earlier, agents orchestrated by retail have the unique ability to just stare at rates all day and rebalance all day and get the best rate on behalf of their users all day. And so if we give those agents more and more options with more and more tooling, like a good example of more tooling, again, is like order limits, where they can say, okay, at this rate, I want to exit this trade or I want to enter this trade. That sort of reduces the cognitive load on an AI agent as well, not just on a retail user. We will just continue to offer a completely differentiated experience to all other like DeFi programs, which is kind of hard to say in this industry. There's a lot of copy pasting. So
of course,
that's our two like core focuses.
Cool. That's super interesting, and I'm excited to see where this heads. In fact, I'm kind of tempted to go try a few of these strategies out myself and collect my Cloud Code instance.
Tell me how it goes. Yeah, I'd love to hear your feedback.
I will do. One last question, maybe. Why is there such a big differential in terms of borrow costs for USD1? Like why? I'm trying to understand why that is, because maybe depending on the answer, I just take all of my spare cash and just put it at 40% APY.
Yeah. So number one is USD1, last I checked, was like incentivized. So in USDC or whatever borrow asset you were using, I don't think was incentivized. So incentives can like skew the lend rate pretty heavily. Like that's number one. Number two, I think USD1 has a different risk profile than like USDC or USDT right now. You know, like people are just less sure of the team and management, and you know, like there's less transparency overall, and that's not a good or bad thing. That's just like the nature of financial products. Like every financial product has a different risk adjustment, and because of that, lenders need to just, in order to lend into that asset, they need a higher lend rate. So I could pull it up too. I think, isn't the USD1 that you're looking at, last I checked, it was on a different venue, right? It wasn't on P0, or is it on P0?
I think it is on P0.
Oh, interesting.
There's stablecoin arbitrage. I mean, it's currently the top stablecoin arbitrage ones seem to be on USD.
Okay. Yeah. Last I checked, when I was looking at USD1, I saw a really high rate on I think it was like Camino, and then we were getting, the bar was coming from P0, and Camino was I think they were like sunsetting a specific market that had like USD1, and so a lot of
Got it.
lenders were exiting and a lot of borrowers still had their borrows. So they kept pushing up the lend rate. And so this is something that P0 can uniquely capture. It's like when like these events happen, when, you know, a team decides to sunset a market, there's going to be an opportunity available for like a month plus as this happens. And again, previously it was impossible to capture this across multiple venues. And so, yeah, we have the ability to do that.
All right. Super interesting. I think we should leave it there. Thank you so much.
Thanks, man. Appreciate it.